Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only, and yes, amazing Anna Kelly. Hi, Anna.
Hi, amazing Michael.
How you doing today?
I'm doing great. Thank you.
Yeah, so we got another CPI report yesterday, which I'm sure you saw, right? Just to summarize for folks that may not see it, expectations were for 7.3. Last time was 7.7. They came in at 7.1. All of that is headline. I will point out that core, as I have called, is being stubbornly high. It's at 6%. I think it
Mhm.
would be interesting to talk about core CPI when headline peaked at 9.1 was 6%. Headline today is now 7.1 and core is 6%, right?
Yes.
This is why I keep telling people to focus on core, not headline. But needless to say, inflation is coming down. I would say the Fed is winning. Why don't we talk about inflation first, what you saw there, and then we'll pivot to the Fed day next.
Sure. Yeah. I was pleasantly surprised and not shocked that, headline inflation came down. I mean, once the Fed starts rapidly raising rates the way that they have, it's the exponential increase so rapidly.
Mhm.
It's always going to slow, demand. And when demand slows, prices come down. It's simple economics 101, supply and demand, right?
Right.
So it did not surprise me that it came down. I was thankful that it came down more than what the expectation was.
Mhm.
The reality is the expectations, there's no way for people to predict. Even the Fed doesn't know what to predict, right?
Yeah,
They,
exactly.
they essentially do their thing. They tighten monetary policy, they raise rates, and then they say, let's see how it plays out. And it's going to take 6 months or so to play out. And they really don't know what areas are going to be hit first. But generally speaking, those things that are discretionary to the point of headline start to come down first. It's the
Mhm.
stickier inflation, that core, that's harder to come down because it's things that people need, right? Wages, home,
Exactly.
energy, transportation, et cetera. So I think that it's really important that you pointed that out, that don't get too excited, that the headline came down because core hasn't come down. It's not over. The Fed is not going to quickly pivot, right? There's still work to do, and it's going to take some time for that core
Yeah.
CPI to come down. But things are heading in the right direction in terms of bringing inflation down overall.
Yeah. I see if you agree with these statements. One, I've been saying for 6 weeks now, and we'll continue to say the Fed is winning. They're winning, right? They're the they're having an impact, right? I think that's a fair statement. What do you think?
Yes, the Fed is having an impact. Yes,
Yeah,
in the right direction.
in the winning in the right direction. It's not surprising to the upside. We have a clear trend, right? 9.1,
Correct.
7.1.
Correct.
It's all
And for
good.
those that are going to come in and say, wait a second, they're doing terrible. Why are you saying they're winning? They're winning the fight against inflation, which is their goal.
Yeah, yeah, absolutely. Here's the one that really scares me. So there was a chief economist yesterday, I want to say from The Economist, somewhere, came out with a quote that I'm glad I only saw one place. But he said, and this is really saying what Jeremy Siegel is saying at Wharton, inflation is over, stick a fork in it. I'm like, what are you, what are you, what are you talking about? I mean, it's not over. We're going to have inflation above 2% all of next year and probably all of 2025. I mean,
Yes.
I don't see it. What do you see?
I agree with you. I don't agree with him. And I've seen just as many economists who say, hey, there's some time here. We're going to have stagflation. And I tend to believe we're going to have stagflation. And again, I'm not an economist, but I read a lot. And
Yeah.
I study a lot about history as you do as well, right? And what I've come to kind of understand that I think would be helpful, for all of you listeners is that there are economists who are microeconomists, there are economists who are macroeconomists, and they look at different numbers, right? So some are looking out basically these cyclical trends, which are shorter term.
Mm-hmm.
And then some are looking at these long term secular trends, like
Yeah.
what's the long term economy going to be? And the reality is, while short term costs are up, inflation is a bear that we're dealing with. There are many things in these secular long term trends that show the economy pretty much globally is actually slowing down. It's on a downward trajectory. lower production, lower GDP, lower costs of things, maybe deflation for the long run, right? So my suspicion is the economist is probably looking at these long-term trends and saying, hey, we're heading into these really recessionary territory and maybe for a long term. And maybe he thinks, on the blip of long term, another year or two of inflation isn't a big deal. However, there are a lot of other economists that also looking out secularly think that the era of the Fed saying that their stated goal of 2% inflation is over. That there are certain pieces, to your point of the core CPI, that are going to be really sticky. Wages. We have less people working, less people choosing to work, less workers, less demographics, in terms of age and population of workers over the next several decades. And so wage inflation up, energy being totally redistributed globally, new production in other countries, your own country, for example, is going to keep energy prices high. Housing, regardless of what you think might happen with prices, if you need to rent or buy a home, it could be more expensive. Food could be more expensive until things realign, right? So I believe that for CPI, there's going to be higher inflation than the 2% we've been used to, along with slowing growth and production. And that's more akin to stagflation over a longer period of time. Just my 2 cents.
No, I agree with all of that logic, all of that. So let's pivot to the Fed. It's Fed day. We're obviously talking before the Fed decision, so all of these are just best guesses. I would assume that you're on board with 99% of folks that we're going to get a 50 basis point move today. It's kind of a layup.
Yes, I hate to go with the 99% because I like to the crowd, right? But the reality is the fact that inflation looks to be cooling and it looks like what the Fed is doing is working means that they're going to continue to raise rates, but not at 75 or 100 bips. It's cooling there. I think they're going to go up 50 and say we still have work to do. Core is still at 6. And we need to keep rates there until we bring wages down and core down. I think 50%. I'm not a betting woman, but if I were, I'd bet on it. 50 bips. 50
bips. Yeah. So now this is going to be the talk track today, tonight, or tomorrow. I almost guarantee it. The market's going to start putting out the idea that this is the last Fed rate increase, right? We're not getting one in February. Inflation is falling off a cliff. M2 money supply is shrinking. Deflation is here. Unemployment's going to skyrocket after the holidays. The Fed's done. I don't see that, but I'm predicting it right now. I said it at 8:13 a.m. Pacific time. I suspect by 2 p.m. Pacific time, we're going to see articles saying the Fed's done. They're not doing anything. So do you think that's likely, possible? I mean, could this be the last rate increase?
I don't believe so. I don't believe so. And again, I think it's because when the Fed knows that core is high, and that's really what they've got to get down. And it hasn't moved, to your point, right? So if you look at where the things that really impact the economy the most, all of the necessities rather than discretionary, those are the things that if they become really sticky, the Fed doesn't want 6% inflation forever. So I think until they get it down to about 4, I don't think they're going to pivot. Now, maybe they pause, will they raise in February? It's anybody's guess. We have to see what happens between.
I'm going to put it out there right now. They're going to raise 25 basis points in February, and I'll even say March. Yeah.
I think they will. I think they will too, at least in February and maybe in March. I saw an interesting thing, a show for another time, that China looks to be potentially actually going after Taiwan. So there's been some military movement earlier this week. If that happens, all bets are off.
All bets are off. All bets are off.
If that doesn't happen and the war between Russia and Ukraine goes away, that could impact supply chain, could impact prices, and who knows what's going to happen. So that's why I say who knows. But I agree that is not done. They're going to raise rates in February and probably in March. And again, when they raise these rates, it's 6 months that it takes them to see how it's going to impact the economy. This is not a quick lever that's pulled and suddenly everything is fixed. It takes some time to run through the financial system.
Yeah. And again, I think there's one last thing kind of on this Fed pivot thing. I just want to remind people, you really don't. And when I say Fed pivot in this context, it's a cut. I want to just say it right here, right now. You do not want a Fed cut, because if they have to cut, it means something bad broke.
Yes.
Right. We don't want that.
Right.
A pause.
A financial crisis that makes them have to switch from goal number one is kill inflation to goal number one is bring back the economy.
Yeah, survive. Right? Yeah, we got to survive. We don't want that. I think the only thing that will be interesting is a Fed pause. I think it's a worthy discussion about February. I think it's a great discussion about March.
Yeah.
Anything post-March, absolutely. But I think talking about a Fed cut in Q1 of 2023 is dangerous because of what that means, right? What had like A/B scenario, I'm like, you really don't want that.
For sure. We live in this microwave society. We have everything at our fingertips when we want it, right? And we want this to be able to be a magic pill that just happens and everything's back to normal, right? If you look at economics, you can see that before COVID even happened, we were on a downward recessionary trajectory, right?
It's why I sold an apartment building in 2019. Little did I know that decision cost me $500,000, but I still think it was the right decision.
I was right there with you. I sold some too early in 2019 and 20 and 21, right? Not knowing, because it's very difficult to time a bottom. But
I didn't predict a pandemic. I didn't
either. I didn't either. And I thought that would be a depression, and it basically was, but very quickly, right? And the government got us out of it. Now we're kind of, reaping some of the
hangover.
The hangover, right? But the point being, this is something that doesn't happen overnight. And so, if there is a pivot, it means there's some kind of financial crisis. The other thing outside of war that makes me a little bit nervous, right, is that I know from studying prior financial crises that what happens globally, not just the inflation rate of the United States, really can impact how the Fed reacts and central bank coordination. So there's been some headlines this week about potential pension and bond market collapse in the UK. Currency imbalances. And so when you start to see, you've got to watch currency imbalances, you've got to watch what is rates doing in other countries. And you can bet that central banks will coordinate to try to keep global price stability, global interest rate stability. Meaning, one country's not doing better than the other, so there's not huge trade imbalances and huge currency wars, right? So I'm watching kind of those things happen. And the other big financial crisis that could happen, I've talked about a little bit, is that there's $2 quadrillion in the derivatives markets that are dollar-denominated debt, much is variable, and it's really fuzzy in terms of the books. It's not well regulated, it's not well reported. And so if the Fed raises rates too high for too long, it could cause a credit and liquidity crisis. If that happens, the Fed will absolutely pause. They usually let things crash for a few months before they'll come in and pivot and clean up what's left.
They want to get rid of the excess. Yeah.
Right. So I'm hopeful there's not a financial crisis and that the Fed raises rates through early, 2023. Then there's a pause for the year. And I think in 2024, we start to see some natural, we've been in recession. The Fed wants to bring us back and stimulate growth. But they've got to wait long enough to know that they've killed inflation. And it's going to take, I think, a year or two to ever hope to get inflation back down to 2%. Wouldn't surprise me if they change and say the new normal is 3 or 4.
2.5, 3, 3.5. Yeah, it's going to be an interesting time. Again, I just want to remind you that we don't need a Fed. We don't want a Fed pivot. We don't want an emergency rate cut, because that means
And don't go make a drastic financial decision, a big money bet that in a month or a quarter or a year, rates are going to be at a certain place, right? This is a long-term game, and you've got to be malleable and say, if rates go up, here's my plan. If rates come down, here's my plan. Because we've learned through 2020 and 2021 and 2022 that there are lots of these red herring events that can happen that can totally change the normal path of an economic or real estate cycle, you have to be malleable. And that's my biggest piece of advice is have multiple purchase strategies, multiple exit strategies, multiple hold strategies, and be able to basically do an analysis of your properties and your investments that say, how do I stay resilient regardless of what happens with rates? And that's kind of where I am today.
That's amazing. This is a lot of fun, folks. Again, we do a daily show here, daily financial news. I'll keep you updated on what's going on. And Anna and I have an amazing playlist just called Anna REI Mom. Go check it out. Thousands of hours, I would suspect, are there now. Anna, where can people find you?
Yeah. Great. Yes. On the playlist, you can find me on social media at Anna Kelly REI Mom, coaching and masterminds at reimom.com. And if you're an accredited investor looking for multifamily investments that are recession resilient and make an impact, you can find me there at greaterpurposecapital.com.
Awesome. Thank you so much.